Well, last week we spent some time talking about how to diversify in the stock market, but what if you're a little bit risk averse? What if you just don't want to have all your money or any money in the stock market? Well, if that's you, stay tuned to this week's episode of the Retirement Income Source, where it's all about the income. Welcome to Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host Sarah Samuels. And today we are talking about non-common stock alternatives. Last week we talked so much about the stock market and with the tech stocks seeming to be slowing down in the growth trajectory right now, and other stocks from other sectors starting to do well, how to diversify in the market. But today we're going to talk about what if you don't want to have all your money in the market? What other options might just make sense for you?
Dave, it's wonderful to be here with you and, of course, with all of our listeners. And I was thinking as we were doing the show last week, we talked a lot about the stock market. It was all about the stock market. But, of course, we're a retirement income source, and we are appealing to viewers with needs all around the different when it comes to risk tolerance, right?
Who might be too conservative to have a lot or, certainly not a majority of their money in the stock market. Yeah,
exactly. People like that maybe are looking for those other options outside of the stock market so they could, be as conservative as they can be.
How you doing, by the way? I know you were out earlier this week. You had one of those terrible migraines. Are you okay? Everything good?
Yeah, I'm doing better. Thank you for asking.
Yeah.
But I know if anyone suffers from migraines, they're not fun, and sometimes they really knock you off your feet for a little bit.
Good. I hope I didn't just create a HIPAA violation here on the air. That's not that would.
No, that's okay. You're not my doctor, Dave.
That's okay. Oh, good.
No
so
HIPAA
don't
worries.
count to doctors.
No
All right.
worries. Only with doctors.
Employers too, though. Oh, I think I just did.
Oh, maybe we're into some trouble there with compliance.
Well, no, it's so true that. We talk about people wanting to lower the risk as they get closer to the market, closer to retirement. They want to be more conservative. And last week we focused all about, this tech bubble now, it's not to say it's a bubble, it's going to burst, but technology stocks have led the market for the last 2 years. And so far this year, the first couple months, it seems to be broadening it out in the other sectors, and all about how and why to diversify in other sectors if you're at or near retirement. But most of you don't want to have all your money in the market. So what other options do you have? Well, it's what I like to affectionately call, as we're going to talk about today, Sarah, the universe of bonds and bond-like instruments.
All of the income-generating investments available to you. And we want to ask our listeners to please call in to our Ask Dave hotline. That number is 800-822-1111. Please leave us a voicemail with your name, number, and your question for the show. And if we answer your question on the show, we'll make sure you get a copy of Dave's book, The Retirement Income Source, The Ultimate Guide to Eternal Income. So our first question here comes from Cameron out of Rhode Island. Cameron, thank you for calling the hotline. Cameron's message said, bonds have been pretty lackluster over the last decade or so. Dave, do you think that will change?
All right, Cameron. Well, good question. At least Cameron's not hating on bonds. I was expecting
he's open-minded.
I was expecting a hating on a bond conversation, but no. So you're absolutely right, Cameron. Bonds have been very lackluster, and part of it's because of the lower interest rates, right? So if you bought bonds 10 or even 15 years ago, if you bought a government bond, there's a good chance that you were locked in at 2.5%, maybe even 1.5%. You were locked in at a very low interest rate. And because bonds lock in, that makes it a lackluster return. But Cameron, now to add insult to injury, whammo, right? 2-3 years ago, the Fed starts raising interest rates, and we all know that when interest rates go down, bonds tend to go up in value, and when interest rates go up, bonds tend to go down in value. So now if you're sitting back getting 2% interest a year, 2% interest a year, and really no more, but all of a sudden now your bonds dropped in value, well, it made it even worse. So yes, the returns for the last, not just decade and a half, Cameron, with bonds have been pretty lackluster. Now, what's different today? What's different today is interest rates are higher. So if you're talking about government bonds, for example, and we're not, but if you're talking about government bonds specifically, a 10-year bond right now is 4.5%. So it's not 1.5, 2 or 2.5. It's 4.5. And with the Fed's movements now, if anything, tending to be more lowering rates as opposed to increasing rates, that means you could get the 4.5% and the bonds could actually go up in value over time. So again, you're locking in a better interest rate at a better time. So with bonds, it's all about when you get in. It is with stocks too, but it's really about when you get in when it comes to bonds. Now, If you're dealing about corporates or other issues, now you can get much higher than 4.5%. So Cameron, I hope you're listening for the rest of the show. You're here with us today because we're going to talk about all those options in the world of what I like to call bonds and bond-like instruments.
Cameron, thank you so much for leaving your voicemail on our Ask Dave hotline. All you have to do is call 800-822-1111 and leave us your name, number, and your question for the show. And if we use your question, we'll make sure you get a free copy of Dave's Amazon bestseller, The Retirement Income Source, Ultimate Guide to Eternal Income. You're listening to The Retirement Income Source, where it's all about the income. I'm Sarah Samuels, here with David Scranton. Today we're really talking about options outside of the stock market that generate income. Just a few weeks ago, we talked about all the different options within the stock market, but we wanted to really appeal to our viewers that maybe have more conservative risk tolerances that are really saying, hey, maybe I don't want to be in the stock market at all. What options are there for me?
Yeah.
And Cameron, thank you for being open-minded with your no trashing bonds, right? But, you mentioned, Dave, that the returns, right, they haven't been great over the last decade, last 15 years or so. But now with interest rates going up, maybe it's not a bad time to buy into bonds. Maybe there's an opportunity there.
Yeah, there is. And, when interest rates have gone up, so they're higher now, they're not going up. And that makes a big difference because when interest rates go up, it's not just bonds that tend to go down, it's even stocks, right?
Yeah.
As we always talk about in the show, as Warren Buffett always says, when interest rates go up, the value of virtually every financial asset goes down.
Right.
And just last week, as you indicated, we spoke about stocks, how when stocks go down, the dividends are declared in dollars per share, not percentages. So it doesn't mean that the dividend drops, the income drops. In fact, the reality is that in many cases, the income actually stays the same. Those dividends tend to be sticky because corporate America hates to lower dividends. It's shareholders don't like it. They tend to sell stocks when they do and so on. But yet dividends can change. Dividends can go up. Dividends can go down. Now, the difference, of course, with a bond, as you know, Sarah, is bonds are a contract, right? So if you buy a bond, it's got a par value or a face amount, right? This essentially is the amount of money that was lent to the issuer of the bond when the bond was first issued, whether it's the government or it's a municipality or a corporate, depending upon what kind of bond it is. Every year, in most cases semi-annually, you get an interest payment, right? Interest only, and that interest is income, and that's why retirees love bonds. Sarah, as you know,
you get that money
because
every
you get
year,
that
right.
fixed. So it's not just sticky like a stock dividend. It's literally locked in. That issuer has to default or go bankrupt before that
It's a contract.
That's a contract before that interest payment stops. And when the bond matures, as long as there's been no bankruptcy or default, then that whole value of the loan, that whole face amount or principal amount gets paid back to you. So again, you really know what you're getting with a bond every year, and even at the end, providing there hasn't been a bankruptcy or default. And that's why retirees just love bonds, because they're more conservative and they know what they're going to get. Now, they may not have the upside potential of stocks, right? So they don't satisfy the greed as much. But if you're retired and you're trying to replace your paycheck and you don't want to take the risk of it going away or getting cut, well, that's where bonds can be a good tool.
But they're not just government bonds. There's lots of different types of bonds out there.
We'll talk about this today. That's right. We have municipal bonds, state bonds, municipal bonds for municipalities. We have corporate bonds for corporations, and we have this universe, as I like to call, of bond-like instruments, all of which we'll be covering just in the next few minutes. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.
Thanks for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about ways that you can generate income outside of the stock market. So last week's show was all about ways you can diversify inside the stock market and what to look for. But if you are in retirement, or maybe you're a more conservative person and you want to invest outside of the stock market, today is a show for you. So Dave, we talked a little bit about all government bonds and different bonds out there, and people tend to forget that there's municipal bonds, there's corporate bonds. There's not just the government bonds out there to invest in.
Right. And the things you have to look at with bonds are the taxation thereof and also the amount of risk, right? Are you comfortable with the amount of risk? How long the bond is? These are all factors. And government bonds are considered the safest because, in theory, the government, I guess the government can default on its debt. Many governments have, but because the United States has the world reserve currency, we're said to never be able to default, which is true today. Will that be true 200 years from now? Who knows, right? That's the safest. And then we go up from there. Municipal bonds are considered a little riskier, although I would argue they're even riskier than people think in this age where, with the SALT caps, where municipalities have a tough time getting revenue. People are moving from one state to another, right?
We've seen a lot of that, right, over the past few years, especially after the pandemic.
But historically, they've been considered to be safer,
Yep.
one step riskier than government bonds. But the big claim to fame with municipal bonds is they have federally tax-free income. So they pay a little bit less interest than a government bond, generally speaking, but you're going to get that federally tax-free. So that's a municipal bond. Corporate bonds are historically considered to be the riskiest because corporations can default. And there's a whole bunch of different ratings on corporate bonds that you can get into that, like, you and I have FICO scores, right, which determine our credit rating.
Yep.
Well, they essentially have a FICO score, and there are several different agencies that rate the financial viability, stability of the issuer of bonds. So you could determine the risk there. And, of course, the interest on those is taxable. But as I said before, I wouldn't be so quick to assume municipals are a step more conservative than corporates, because corporates, today, corporates can do a lot to raise revenue, to cut back costs. Municipalities, they have a tough time. If they want to raise revenue, it takes a long time to entice people to move to their state. If they want to decrease costs, there's only so many firemen, police officers, and teachers that you can lay off, right? So it's kind of hard. So I would consider municipals and corporates to be the same when it comes to risk. And then when you go from there, you get into that bond-like instrument world that we're going to be talking about a little bit more today, Sarah, where you're talking about preferreds and maybe even some BDCs, some real estate investment trusts, and so on.
Yep, those things outside of bonds, but are bond-like, exactly. And our next Ask Dave question actually has to do with preferreds. But
okay.
First, I want to encourage all of our listeners to call in and leave your question for the show on our Ask Dave hotline. That phone number is 800-822-1111. Leave your name, voicemail, and your question for the show. And if we use it on the show, we'll make sure you get a free copy of Dave's book, The Retirement Income Source, The Ultimate Guide to Eternal Income. So our question here is from Edwin in Connecticut. Edwin, thank you for calling in on the hotline. He says, Dave, you talk a lot about preferred stocks, but aren't those riskier in general?
All right, Edwin. Well, are they riskier than corporate bonds? Yes, but perhaps not in the way you're thinking. You see, stocks have different classes, and when you think of stocks, you typically think of common stock. Common stock really effectively doesn't have a par value or a face value. It did when it was issued many, many years before, but now essentially a common stock can go way up, it can go way down. There's no par value or face value. And it pays a dividend, and that dividend can go up or dividend can go down. So with a common stock, you're really betting on the management team and the future profitability of the company. Preferred stocks are more bond-like than they are stock-like, and they're more bond-like in several ways. Number one, they have a par value. They have a face amount at which they're issued, usually $25 a share for many preferreds. And that's where they get issued. That's often where they get called if they get, if the issuer wants to pay those off. So again, it's like it's a par value, it's a face value. Also, the dividend on a preferred is actually stated on the preferred certificate. So it's not just like a stock dividend where it can go up or down. It's stated. And if a company defaults on a preferred, many companies consider that to be like defaulting on debt. So again, barring a bankruptcy or default, you can usually count on getting that income stream, that fixed income stream. And lastly, preferreds tend to fluctuate more when the bond market moves than with the stock market. So, okay, if they're more bond-like than stock-like, then why are they called preferred stocks? Well, simple. Because bonds have a maturity date, and preferreds typically are perpetual. They go on forever. So does that make preferreds a little bit riskier than bonds? Yes. But are they generally considered to be a whole lot more conservative than common stocks? Absolutely.
And Edwin, thank you so much for calling that Ask Dave hotline. And we hope that our listeners can call in because we love to hear from you and we love to hear your retirement questions. The phone number is 800-822-1111. And if we answer your question on the show, our team will make sure you get a free copy of Dave's book, The Retirement Income Source, The Ultimate Guide to Eternal Income. And thank you for listening to our show today here, Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton. And today is all about income generating options outside of the stock market and really looking at this universe of bonds and bond-like instruments, Dave.
Right.
So we've talked about bonds. We had a great question from Edwin about preferred stocks. And you mentioned they could be either riskier than corporate bonds, but there's a lot of upside with preferred stocks.
There's a reward because you get a higher yield, a higher income payment, right? And it's a whole risk versus reward equation. And that happens within the credit spectrum, but also happens with preferreds relative to bonds. So think about it, right? If we were to go into a lending institution together and you have a FICO score of 800 and I have a FICO score of 700 and we're both applying for a loan, you're going to get a better interest rate than me, right? I'm going to have to pay more interest because I am higher risk. Well, the same is true there. So if a preferred is perpetual, there's a greater risk of something bad happening in forever versus, let's say, a 10-year period with a bond or a 20-year period with a bond.
There's less risk with that bond because it ends eventually, right?
So therefore,
perpetual.
Therefore, the preferred has to have, a little bit more higher interest payment that the preferred happens to call a dividend in this case. But also within bonds and within preferreds, all those different ratings, right? You could have a AAA, a AA, a single A, a triple B, a double B, a single B. And as you go down the credit spectrum, there's more and more yield because it's a riskier instrument. It's a riskier bond or a riskier stock. So not only do you have risk in bonds going from government to municipals or corporates, but then you have risk as you go from AAA to AA to single A to triple B, and all the way down.
Yeah, there's a lot of different things to consider, I think, when it comes to bonds and investing. And it's not necessarily for the do-it-yourselfers at home when it comes at least to bond investing.
No, it's very mathematical. So there are some engineer types or accountant types might be okay with it because it's very mathematical. But the problem with bonds is you can't just go out and push a button on a computer and buy a bond like you can a stock or a mutual fund or an exchange-traded fund. Bonds are negotiated like a piece of real estate. You want to buy a home, you have to go negotiate with the seller, and that's exactly what happens with bonds. So, there is no established price, and if you don't know what you're doing, you can get a bad deal. But we're talking about bonds and preferreds, but in a bit, Sarah, I want to talk about some of the other things, the other bond-like instruments that we always talk about that kind of go into that equation of bonds and bond-like instruments, other than just bonds and preferreds.
Exactly. A lot of people aren't aware of all those different income-generating investments. That's why you call it the universe, right? It's not just bonds and preferreds. So we'll continue covering what those investments are. I'm Sarah Samuels, and I'm here with David Scranton. You're listening to the Retirement Income Source, where it's all about the income. Thank you for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today's show has been all about the universe of income-generating options. There are lots of tools out there that actually can generate income for you. Now, we've talked about bonds. We've talked about preferred stocks, Dave, but it's not just those bonds and preferred stocks.
Well, you're right. It's not. And, some people might stop there. Some people may not even get to preferreds. A lot of advisors just don't do preferreds. They're kind of in between stocks and bonds. You always hear, right, the cliche, stocks and bonds, stocks and bonds, stocks and bonds. Well, that's what a lot of advisors think. So preferreds are a great hybrid, but there's some other things in that category. For example, BDCs, business development companies. Business development companies are the stock of a company that owns loans, right? And a bond is a loan, so it's a bond-like instrument. Even though it's technically considered a stock, it's a bond-like stock. So why do you need BDCs?
Yeah. Why are they a good option potentially?
Well, if you're a large company and you want to borrow money, you're going to go to Goldman Sachs and you're going to do initial public offering, but you have to be borrowing probably $1 billion for it to make sense, right? If you're a small company, you go to the corner, go to the local bank, you apply for a small business loan. What if you're a medium-sized company? What if you want to borrow, a good amount of money, but not enough to make it to go get initial public offering with a huge firm like Goldman Sachs? Well, that's where BDCs come in, business development companies, because they make these loans and they typically pay a higher yield. So a lot of times with BDCs, heck, you can get double-digit dividend rates on those. But the higher quality ones are going to be somewhere in the 7 to 10% range. So you get a 7 to 10% yield in a fund that has lots of loans to mid-sized companies. But you have to be careful, Sarah, because a lot of BDCs have high-risk loans. So, for example, we do at our companies, as we filter through to make sure we get the ones that are either collateralized, they're back with some good company collateral or equipment, and those that are more first liens. We don't go to second or third lien. So there's an art behind buying BDCs, but they're a great bond-like instrument. We're peppering a little bit of that into a portfolio of bonds and preferreds, can do well. And the other thing is, is real estate investment trusts. That's technically the stock of a company that owns rental property, right? Oh, wait a minute, why is it a bond-like instrument? Well, because for those of you who have rental property, you know that lease is like a bond, right? You check the creditworthiness of the tenant, and if it's a 10-year lease because it's commercial property, guess what? They have to pay you for 10 years unless they default or go bankrupt, just like a bond. So even though the REIT is a stock of a company that owns rental property, the income is contractual, much like a bond. So Sarah, those are just two examples of bond-like instruments, and peppering little doses of those into a portfolio of bonds and preferreds can help.
And I want to encourage all of our listeners to call in to our Ask Dave hotline. Again, we'd love to hear from you. Leave your name, your number, and a brief voice message with your question for the show, and we'll make sure you get a copy of Dave's book, The Retirement Income Source, The Ultimate Guide to Eternal Income. Now, our question here comes from Trevor in Connecticut. He says, if I'm a few years out from retirement, do you think I should consider bond funds?
All right, Trevor. Well, I could tell, gosh, you think Trevor's a regular listener or a show or what?
I don't know. I think he might be a new listener, Dave. Go easy on him. He doesn't know
okay.
how you feel about bond funds.
That's all right. We like new listeners
We
as
do.
well as
We
our
love
old
them.
listeners. That's
Absolutely.
okay. All right. So Trevor, all right, we're gonna give you get out of jail free card for that question. I'm not a big fan of bond funds, and the reason is because bond funds have a lot more risk than bonds, right? I said before, when you own a bond, you get an interest payment that's contractual. The dollar amount of the payment is contractual. And when the bond matures, assuming there's not been a bankruptcy or default, you get the full face amount of that bond paid back to you. So you know exactly what you're going to earn if there's no default or bankruptcy if you have a portfolio of individual bonds. If you own a bond fund, though, neither such guarantee exists. With a bond fund, the interest payments you can and will fluctuate, and there's no maturity date. There is none at which it pays back a fixed amount. So that means the two guarantees that make bonds, they make a diversified bond portfolio, Trevor, attractive to retirees and people approaching retirement. Both those guarantees are off the table when it comes to bond funds. So, in fact, if you were to go and study to become a financial advisor, then you would quickly learn that the definition of a bond mutual fund is the stock of a company that owns bonds. Let me say that one more time. The stock of a company that owns bonds. It's even riskier. So if you have a choice and you could do a diversified portfolio of individual bonds, I would take that any day over bond funds, providing that you've got $100,000 or more to cost effectively diversify. Anything less than that, then bond funds might be the only real answer.
Trevor, thank you so much for calling the Ask Dave hotline. And that phone number again, it's 800-822-1111. Leave us a voicemail with your name and number and your question for the show. And if we answer your question, we'll make sure you get a free copy of Dave's book, The Retirement Income Source, The Ultimate Guide to Eternal Income. And we appreciate you listening to our show today on The Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we've been focusing on ways that you can generate income outside of the stock market, even though we talked a little bit about preferred stocks. And Dave, you mentioned there's BDCs, business development companies, there's real estate investment trusts that all do have some risk involved. But again, these are income generating vehicles.
Yeah, to Trevor's question, I do want to make one thing clear. I poo-pooed bond funds because they're a stock of a company that owns bonds. But I said BDCs and
right.
REITs,
that sounds kind of similar, right?
They're similar.
The stock of a company that owns debt and versus real estate.
That's right. But there's a difference.
Yeah.
You can buy individual bonds and avoid the fee built into the mutual fund. In many cases, actually earn more. Okay, you can. But for you to go ahead and to make a loan to a company, number one, you wouldn't have enough money to do it. Number two, you can only afford to lend money to one company, which means you wouldn't be diversified. And you don't have the bandwidth to do the underwriting of their credit. So the only real practical way to invest in these mid-market loans is through a BDC and to rely on the professionals. And unlike a bond fund with a BDC, you're getting a lot more income on a percentage basis than you are with a typical bond.
Part of the reason why you beat up on bond funds is because of that fee, that those hidden fees hidden inside.
Yeah, and because you have an option, you can buy the bonds individually. If you have more than $100,000, you can still cost effectively diversify. And you're right, you're paying that fee. And we charge fees, as you know, to manage money. But we're oftentimes looking at bonds and bond-like instruments. We're not just looking at bonds. We're looking at several of these classes we talked about today, and we're talking about actively managing those.
Right. That requires a specialized knowledge too to even understand the ratings and all these different bonds.
It requires specialized knowledge, and it requires a niche. And unfortunately, as you know, Sarah, most advisors today just don't have that as a niche. Most advisors today, for whatever reason, are still stock market-based advisors, and not even high dividend, high yielding stock market-based advisors. They're total return-based advisors. They think that the same strategies that are good for somebody your age are going to be good for somebody my age, where they look for total return irrespective of how much interest or dividends it pays. And that just isn't the same. Our needs are different, right? We go to the gym. We probably work out differently, right? I'm sure what you do for a workout is different from what I do for a workout. We
Absolutely,
have to.
right. We have different needs, and that's the best way to treat it. Be a specialist, not a generalist. And that's why our show is not called the Total Return Show, right? It's the Income Show.
You've got it. That's absolutely correct. We'll never have a show called the Total Return Show because, for anybody who's part of my generation, who's 55 or over, who's retired or within 10 years of retirement, it's so important to focus on an income first, growth second strategy. It doesn't mean that you're not looking for growth. We all like growth, and growth is a good thing, but income first, growth second.
And thank you so much for listening to this episode of the Retirement Income Source, where again, it's all about the income.
And most important, we hope that you're here with us next week, same time, same station. I'm David Scranton here with Sarah Samuels, and you're listening to the Retirement Income Source, where yes, it is all about the income.